Are you in the best KiwiSaver fund? Last week we got some new data, so in this video I'll share the funds and the providers that got the highest returns. Over the past week, many have posted surprised that our largest KiwiSaver provider ANZ had the worst returns of anyone. Over 500,000 Kiwis rely on these guys to manage their superannuation funds. So keep this in mind when choosing a provider. The biggest isn't always the best. But this is why I create these videos, so you can come to your own conclusions using the latest data and make an informed decision. Will I be telling you who to invest with? Absolutely not. Only you can decide, weighing up your personal circumstances and your tolerance for risk. Let's now take a look at the report. In December 2024, Kiwis had invested $122 billion into KiwiSaver. This is a $24 billion increase in 2024 alone. Morningstar observes continued headwinds for the New Zealand economy, with high interest rates and fragile economic growth. Inflation is easing, though the housing market remains subdued and the labour market is cooling. So in 2024, the New Zealand stock market has underperformed some of its peers, like Australia and the US. Fund managers with larger weightings of local shares may have underperformed for the year. When we look more broadly at the KiwiSaver funds over the longer term of 10 years, higher risk funds have generally had higher returns. Aggressive funds have generated an average return of 9.3% per annum, growth 8.3%, and all the way on the other side of the risk spectrum, conservative funds have averaged about 4.2%. This is true across all the time horizons here on this chart. In terms of market share, ANZ has the most KiwiSaver funds under management with an 18% market share. They were followed by ASB, Fisher Funds, Westpac or BT, and Milford Asset Management, all with over $10 billion in assets. The fastest growing provider between 2023 and 24 is Kernel. Their assets under management increased 167%, from $120 million in 2023 to $322 million in 2024. Their low-fee approach to managing KiwiSaver is attractive to Kiwis, with over $980 million a year being spent on KiwiSaver fees. That's around 0.2% of our GDP, a wild statistic that frankly shows too many providers are charging too much in fees. Let's now take a look at the returns. These are all compared on an after-fees basis, but before tax, as that's different for everyone. In total, there are 21 providers and 308 funds compared by Morningstar. As mentioned earlier, KiwiSaver funds have 5 groupings by risk: conservative, moderate, balanced, growth, and aggressive, from lowest to highest risk. Default funds are the 6th category that sit around the balance mark of risk. Comparing the default funds first, Simplicity had the highest 3-month returns of 3.8% and 1-year returns of 14.4%. Over 3 years, Booster takes the crown with 4.4% annual returns. Superlife slipped into second with 4.2%, and BNZ and Simplicity were tied for third with 3.9%. In terms of fees, Superlife are the lowest here with just 0.2% charged per annum. Westpac, on the other hand, has the highest, charging 0.4% for the absolute worst returns across the board. As the largest default fund, managing almost $900 million of funds here, this is why you shouldn't follow the crowds, and instead, you should let the data guide your approach to KiwiSaver. Moving along now to the conservative funds. Leading the pack over 3 months, 1 year, and 3 years, you have QuayStreet's conservative fund. It's just the baby in the list, managing just $33 million, but even across the 5 and 10-year returns, they've come up second, so they're a pretty reliable fund in this space. Out on top over 5 years is Pathfinder's conservative fund with a return of 4.4% a year. Over 10 years, Milford's conservative fund came out on top with average returns of 5.1%. Looking now at the worst performing funds, you've got ANZ, AMP, and BNZ, generating returns of under 4% over 10 years and under 2.5% over 5 years. Comparing fees, Booster charges the highest fees of 1.11% a year. This is for a fairly mid-pack fund. Generate came up second, charging 1.09%. However, their after-fees returns came up second best over 3 months and 1 year, so their higher fees seem to translate into better returns. Other providers charging in excess of 80 points include Pathfinder, Milford, and Mass, while the average for a conservative fund sits at 0.62%. Now we're looking at the moderate funds. The standout winner here is the Generate Moderate Fund with the best after-fee returns across 3 months, 1, 3, 5, and 10 years. This is despite charging the highest fees of 1.14%. So like the conservative fund, you're paying for quality managers for this risk level. BNZ's moderate fund is also a high performer, coming out second best across the 5 and 10-year returns, fourth over 3 years, and third over 1. ASB's moderate fund did well as well, third over 3 months, 3 years, and 10 years, and second over 1 year. Also featured in the leaderboards are Mass, Milford, Mercer, Westpac's Moderate Fund, and Superlife. Among the lowest performers are Booster, Fisher Funds, JMI Wealth, AMP, Westpac's Conservative Fund, and more recently, ANZ. However, their longer-term performance, which is arguably more important, manages to reach the mid-pack. As mentioned earlier, Generate had the highest fees in the list of 1.14%. Other providers with a 1 handle include Booster at 1.11% and JMI Wealth at 1.1%. The average sits at just 0.81%. Now we've reached the funds sitting in the middle, balanced funds. Over 10 years, Milford's balanced fund comes out on top with returns of 8.3% a year. Over the past year, however, they have struggled with just an 11% return. Out on top over 1 year was QuayStreet with 17 and 21% returns. QuayStreet are back on top with their balanced and socially responsible funds swapping first and second places all the way out to 5 years and slipping into second and fourth over 10 years. Other providers featured in the leaderboard include ASB's Balanced Fund, Generate, Invest Now, Kernel, and Westpac. ANZ, Invest Now's Castle Point Fund, ASB's Positive Impact Fund, AMP's Moderate Balanced Fund, and Forsyth Barr's Summer Balanced Selection have had among the lowest returns. Topping the fees table is AMP's Balanced Fund charging 2.2%. Among the funds with a 1 handle include ASB's Positive Impact Fund, which was a bottom performer. Booster's 2 funds, Generate, JMI Wealth, Pathfinder, and Milford. The average for the category is 0.8%. Now we've reached the growth funds, the category with the most funds invested, almost $40 billion or 1/3 of the total KiwiSaver funds. A standout performer here is QuayStreet Growth, topping the tables out to 3 years and coming up second for the 5 and 10-year periods. They were beaten by Pathfinder over 5 years and the legendary Milford Active Growth Fund over 10 years. Other leaderboard funds include AMP's Growth Fund, Generate, Simplicity, and Invest Now's Growth Options, ASB, and ANZ. At the other end of the spectrum, ANZ came out last over 5 and 10 years with their Balanced Growth Fund. Even their Growth Fund has appeared near the bottom of the rankings for all time horizons. With almost $9 billion invested across their 2 growth funds, it's surprising to see with such resources they managed to underperform their competition. Many of the other providers move between the bottom of the pack and the middle across different time periods. The average annual fees for funds in this category is 0.95%, with Booster, Fisher Funds, several Invest Now options, Milford, Nico, Pathfinder, QuayStreet, and JMI Wealth all charging above 1% a year. Simplicity charges the lowest fees at just 0.25%, followed by Invest Now's Foundation Series at 0.37% and BNZ at 0.45%. And finally, we reach the aggressive funds. These take the highest risk approach to investing. Topping the tables, QuayStreet is once again on top over 3 months, with their newly introduced high growth fund generating a return of 11.2%. The average here was just 5. Over 1 and 3 years is Generate's focused growth fund. Over 5 years, Milford came out on top, and over 10 years, Booster's socially responsible high growth fund. There's a few standout funds in this space. Kernel's High Growth Fund has been around for just over a year and slipped into second across the 3 months and 1 year periods. SBS have also appeared in the leaderboards all the way out to 5 years. Other funds featured in the leaderboard include Simplicity, Superlife, ASB, Mercer, and AMP. There aren't a lot of funds to compare when we look at the bottom performers, but ANZ came up last in 16th over 1 year, and Nico last in 12th over 3 and 5 years. The average fees for these types of funds is 0.98%, with Booster Shielded Growth, Generate Focused Growth, and QuayStreet's High Growth Fund all charging over 1.3% in annual fees. So that rounds out the multi-sector fund tables. Morningstar also looks at single-sector funds which are less diversified and more targeted in their investment approach. Fisher funds have the highest cash fund returns of 2.9% a year over 10 years. They were followed by ANZ and Superlife. Looking at fixed income funds, most haven't been around for long. Topping the table is Superlife's New Zealand Bonds Fund, earning 3.5% a year over 10 years. They were joined by QuayStreet and Superlife Income. International shares, of course, had a pretty exceptional year. The S&P 500 was up, but our local market wasn't, so it was a good strategy over the past year. Like fixed income funds, these haven't been around for long either. Topping the 10-year tables were One Answer's Sustainable Shares Fund, QuayStreet's International Equities Fund, and Superlife's Overseas Shares Unhedged Fund. Kernel has also done pretty well with their Global 100 and Global ESG funds among the top 3 performers over 3 months and 1 year. There's a few funds in this list that have major volatility in their returns as well, like Nico's ARK Disruptor Fund. Moving along, we have property funds. With high interest rates throughout much of 2024, all the funds came up negative over 3 months. Over 10 years, One Answer's Australasian Property Fund came out on top. And over 5 years, their International Property Fund was the only one to generate a positive return. As compared to the international share funds, those investing in Australia and New Zealand have underperformed over the past year. Looking out to 10 years, Superlife's Australian Shares Fund has topped the table with 10% returns. Their Australian Financials Fund, investing in Australia's largest banks, topped the table all the way out from 3 months to 5 years on the back of strong performance in this sector. And finally, we have the miscellaneous funds, which have an unconventional KiwiSaver investment focus. There is no point in comparing these funds as they're all so different. Koro have a Bitcoin fund that made a 65% return over 3 months and 142% over 1 year. So if you want to invest in Bitcoin and alternative assets, this might be something to look into. Kernel has a Kensho Moonshot fund as well, which invests in disruptive industries. They've returned almost 30% in 3 months and 14% over 1 year. So those are some interesting items in this list. If you are looking to improve your investment portfolio tracking in 2025, make sure to check out ShareSite. They have one of the best trackers on the market, allowing you to get a better view of your investment returns through capital gains, dividends, and currency. It also has a range of useful reporting tools, including one that does your FIF tax calculations every year, saving you time and potentially money. If you sign up using my link down below, you'll get 4 months free on their annual plan. If you enjoyed this video, please make sure to like and subscribe. It really helps the channel and pushes me to create more content just like this. You can also check out some of my other investing content somewhere over here. Thanks for watching, and I look forward to catching you on the next one. Cheers.